Hello, everyone. My name is Kevin Hurley, and I am redoing a webinar for May 4th that I tried to do on April 22nd. I did not like the way it came out, but I felt this was important, so I'm going to go over this one more time, and I'm going to try to do the best I can to represent what I was trying to do a couple weeks ago. I'm going to represent for you today. In plain English, what I would like to go over are 4 points. And the first point is, are you able to successfully trade for yourself? That's the first question. The second question that we're going to point out, are your investing decisions sound choices? Everyone makes mistakes, but I want you to understand what you're coming up against. Number 3, which I think is the most important and which I feel makes or breaks portfolios. Number 3, are you hedged against a major downturn? And number 4, how are you taking profits in the market? Which all of these go down to this simple question. Are you being 100% accountable and honest with yourself? If you're not, if you can't answer that question, I'm going to politely say you have no business answering those other questions about yourself. And more importantly, if you can't answer yes to my all caps last question there, my recommendation, and as politely as I can tell you, there is no place for you in the market and you need to get out. Now, this webinar came to me in a PDF format by Martin Armstrong. And someone sent me Martin Armstrong's PDF, How to Survive Your Own Trading Decisions. And the 3 points he was working on was understanding liquidity, understanding timing, and mapping resistance and support levels. So let's go through those, and let me go through this PDF that was given to me. A subscriber basically typed in, question, hi Marty, hope you are doing well. I have some question regarding trading to you. Why is this game mentally and physically so hard to learn? And when you see mentally and physically, you always go right to greed and fear, right? Fear and greed. Those are the 2 emotions that mentally zap your strength. Normally, every trade has a 50-50 chance. Let's change that. In all honesty, that means you have an equal chance to win. I disagree. I think the market is a 1 in 3 chance. If your trade or your position goes sideways or down, you have a 2 out of 3 chance of losing money. The numbers I calculate, that says you have a 67% chance to lose while you only have a 33% chance to win. If you're trading options, futures, Forex, some of these other contracts, these other derivatives that are out there, it's even worse. Time decay, volatility, there's a ton of different things in there. You actually have about a 20% chance of winning and an 80% chance of losing money. Yes, the market is stacked against you. For that reason, I disagree with the 50-50 chance because I don't see those numbers. I see it much worse. But normally every trade has a 50-50 chance, but if I enter the market, everything is going different. And that difference, quote unquote, right? Just trade against me and you'll become even richer. It's crazy. So what he's saying is his trade setups are wrong. Every time he places a trade or enters the market, it goes against him. So just as a rule number one, his time horizon is not correct. I'm self-analyzing what's being said here. His risk tolerance level is not correct. Well, Kevin, what if he's doing option spreads and he loses half of it in the first day? So what? That happens. Welcome to investing in the stock market. That can happen if you're doing option trades all the time. If he's buying a stock position, how long does he have for that stock position to become profitable? The correct answer is, well, for forever until it goes out of business, right? Well, if he has forever for it to become profitable, why is he worried if in the first day he puts it on, it goes against him? The time horizon, the risk tolerance for this individual tells me he or she should not be in the market. Mentally, they cannot handle standard movement of stock positions, not even volatile times, but standard movement of stock positions. This individual does not have the risk tolerance to handle everyday market movements. Now, everyday market movements are a lot different since 2008. The new normal in the VIX is about 3 times as volatile as it was pre-2008 time periods. I get it. But if the narrative hasn't changed, if he's done his fundamental, technical, sentimental due diligence on the basic levels of investing that everyone thinks they have, but no one seems to do, if you do your research, in the first day it doesn't go against you, as long as the narrative hasn't changed, it's okay. I think my biggest mistake is to enter a trade way too early. When I read the market could turn maybe in 2 weeks, my reaction is to go short immediately. And I just went, oh my gosh, this individual says, it's just so dumb. But what is it has brought me the heaviest losses? If you're shorting the market, you don't understand that you're taking unlimited risk. Of course, unlimited risk means you're going to take your heaviest losses at those times. They shorted the Dow from the 30,000 level again and again and again. It's like, oh my gosh, yes, that's a big round number, but just a little bit of due diligence, a little bit of market analysis in seeing the trillions of dollars of stimulus that we put in, it'd be crazy to short the market at round numbers or new highs. We just put in, well, let's put it this way. In 2021, we're going to put in more stimulus than all the presidents and the governments that the U.S. has had since the beginning of time. Why would you ever short against that market? Why would you ever short against the Fed? Fed already said, hey, we're in it for the long haul. We're good. We're going to not raise rates. They're set. If you don't understand the risk, and I just said that off the start, right? If you don't have a way to hedge against those downturns, and your way of hedging is going short immediately and taking unlimited risk, you're going to have heavy losses year in and year out. So Cratch is like market navigation, I know that, but when the Navy says right, I dove left. Always in fear. There's that fear word that the market could crash like last February. Well, make sure you go and you check 2020 results for Hurley Investments. That'll show you what we did in February. But there's that fear and that greed, right? Maybe you could write, you spelled right wrong, a bit more on your blog. What were your easiest secrets to become a successful trader? Simple. You control your fear and your greed. You hedge your risk in your trades. It's really that simple. Maybe a sample account of which ETF stocks are promising for the rest of 2021. So right now, this individual is saying, I don't want to do the work. I want you to do the work so I can blame you when I lose money. Or some live trading sessions via chat on your Socrates platform. Sorry for disturbing you again and again, but I know you're the only man who really know how the game works. You might understand my little problem. By the way, nice call for the top in Bitcoin. Thank you. Have a good day and best wishes. Oh. So then Martin Armstrong came back with this. And it's a pretty educational piece. But number one, it's most critical to map out the resistance and support levels. Time and time again, I see people putting returns that are way above a resistance level. Just because you want to make 20% on every trade or 25%, do your technical analysis. See if the stocks hit there. See if where it can hit. If there's a bunch of resistance levels, things like a 50-day, a 100-day, a 200-day simple moving average, well, I guess 100-day is kind of worthless. No one uses that, right? A 50-day or a 200-day simple moving average, chances are the stock's not going to go above that. If you have a triple top, chances are the stock's not going to go above it. Do your research to the downside. Tell yourself how low a stock can go till you might expect a bounce, where these support levels are at, right? So you know where to dollar cost average if you need to. It is critical to go back to level one basic information about the stock market. Do your due diligence. Do your technical analysis. Do your fundamental analysis. Do your sentimental analysis. Do your market analysis. Give yourself every piece of information to make your best educated decision. Here's Martin's answer, and I love it. Most common problem in trading have been overtrading and anticipation. I agree with that. Many think they're limiting the risk by trading too frequently. Trading too frequently actually increases risk. Every time you're creating or adjusting a new trade, it's creating a new risk. So do they want to risk, say, $100 to continually set a trade and lose $20 10 times in a row? Don't want to lose 100, but are willing to lose 200 by setting stop losses and just losing $20 time and time and time again. The real secret to trading is recognizing that your opponent is really yourself. And I found that interesting to say because in real life, I think that's a key, right? The real secret in real life is realizing that your number one opponent is yourself. The problem with systems that requires human judgment is that they expose your human frailties. Whether it is looking at chart patterns, candlesticks, or wave patterns, all of these forms of analysis require experience, and whether you have the natural tendency to be artistic. Those who have artistic eye can see patterns easier than those that do not. You will see a face in the cloud shape, but others will say you are nuts, it's just a cloud. And I'm gonna really press on what he's gonna say on this next paragraph, but I 100% disagree. The key is to try to eliminate that human judgment as much as possible. So let me say what he just said. I'm going to highlight that and say what a joke it is. The key to eliminate human judgment as much as possible. So their version of dealing with fear and greed is to eliminate the power of the human brain. Not to limit your greed by hedging your risk in the trade, not to eliminate your fear by taking less of a profit, maybe doing less of contracts or less number of shares, or by hedging your risk in stock ownership. It's to eliminate human judgment. So what they just told you here is you need to dehumanize and take your brain out of making investments. I'm going to say this as politely as I can say this. That is the dumbest damn thing I've ever heard anyone say on all of God's green earth and in the heavens combined. Don't use human judgment. Don't make yourself smarter. Don't give yourself experience. Don't do the hard work. Don't do your best possible guess based on hours of research and education. Just take human judgment out of the equation. In fact, just buy our dumber than dumb, stupid, oh, what am I going to try to say here? Our stock pickers that's done by a screener. The screener was created by a person. I'm shocked, but this is a sales pitch. Take the human judgment out. Just spend thousands of dollars doing our artificial intelligence programmed by a human stock screener and just follow what we do. Well, you want to see a con artist? You just read a con artist's way of trying to entice you to spend money with them instead of using your own brain, instead of educating your own brain, instead of gaining the experience, instead of taking a step back and on a $100,000 portfolio, only placing $500 trades versus 5,000. You only need to look at the setup when the price is reached, but during the time target. The monthly array pinpoint April since the start of the year. When you look at the weekly and target last week, I mean, they're giving you a bunch of gibbly joblish here, right? I like their last paragraph as well, but once again, I'm going to strongly disagree. With every trade, you must always define where you are right and where you are wrong. I disagree. On every trade, you must define where your primary exit is when you want to get out and what you're going to do if it doesn't go the way you have planned. There are no depends once you put a trade on. 100% agree. All your depends should have been thought out and looked at through technical analysis before you put the trade on. We only have a depend in the setup. 100% agree. Did it reach the price? Did it reach the time and the price? Other than that, once you're in, some people hate to take a loss because it acknowledges they were wrong. If you have the setup, then selling against the high on a target week or day with the stop above that high makes sense, and it is lower risk. If you think it will crash, you keep selling on a hunch, you will lose. I agree 100%. But remember, they told you not to use your brain, not to do those calculations, you got to take emotion out of it. I apologize, but if you're doing this, you can't take out the human, how do they call it? The human judgment. That human judgment is needed to make your best educated decision. And then this is the funniest. Look at their quote here, right? Knowledge comes from recognizing a mistake and adapting until you get it right. Stupidity prevails when you refuse to admit that you are wrong and seek out others to blame for your own failure. Guys, here's what I'm going to tell you. It's plain and simple. Most people tell me when I used to work in the education side of the stock market, I already have the basics. I already understand technical analysis, fundamental analysis, sentimental analysis, market analysis. Yet you know how many people actually do that when they place a trade? I would dare to say it's less than 1%. We put a trade because we heard it on Fast Money on CNBC. We heard it on the 5, some news on the 5 from Fox News that means we could really see a growth in this position. 99% of the people that I talk to never do what is always the first level in education: fundamental analysis, technical analysis, market analysis, sentimental analysis. If you fail to do your foundation, if you fail to put the effort and the research in before you place your trade, your best educated guess is not very educated. Your best educated guess is failing to use your best judgment and the knowledge that's needed from doing that work. To hear Armstrong say human judgment has no place in the stock market, I disagree. I think fear and greed have a big place in our stock market. And that fear and greed should be what drives you to do the boring, methodical, level 1 in education, fundamental, technical, sentimental, and market analysis to help you understand where your trade could go and how it could turn against you, to create plans of what you're going to do if it goes up, down, or sideways, to create adjustment strategies to fix your trade if your initial expectation is wrong. And for crying out loud, you've got to understand and calculate your risk. And if you ever send a letter in that sounds like this O person that truly doesn't understand their own risk tolerance and feels this way in the stock market, it's time for you to get out. There's not a place for a loser in the stock market. That's just funding other people's profits. It's funding the big houses, the big boys. That's not what you would be in the stock market for. It's time to get out. I appreciate you guys letting me redo this for you. It was a pleasure. I hope this time I have a much better recording and I better represent myself on what I saw in this PDF as it was sent to me. I will get this posted here today. I appreciate you guys working with me through this COVID world, and I look forward to talking to you here in the near future. Bye-bye.